Hello, friends. If you're on the UK, state pension paid every 4 weeks, and you've seen one of the videos circulating this week claiming that only certain national insurance numbers are receiving a special extra payment in June, this one is for you. You've probably wondered whether your NI digits actually determine whether you get a 13th 4-weekly payment somewhere in the year, or whether that is something everyone on the cycle receives, regardless of what those last 2 digits happen to say. The comment sections under those other videos are full of people arguing about exactly that, often with real certainty on both sides, without anyone landing a clean, sourced answer. So we are going to walk through it. What your national insurance digits actually control, what they do not, and 3 checks worth considerably more than any single extra 4-weekly payment sourced against what the Department for Work and Pensions and HMRC actually publish. Quick context before we go further. This video is for UK pensioners on the 4-weekly state pension cycle who want a clear, honest explanation of how the payment schedule works and a practical list of checks worth doing this month. Everything here comes from publicly available official information, the Department for Work and Pensions, HMRC, and the House of Commons Library Benefits Briefing for 2026 to 2027, and I will name each source as we go. This is educational content only. It is not personalized financial, tax, or benefits advice. And nothing in this video is a promise that you will receive any specific amount of money. The figures I mention are official published rates and official averages. Your individual outcome depends on your own record and circumstances. Before any major decision, speak with a free advisor at Age UK or Citizens Advice, or a qualified professional who knows your full situation. With that said, here is what actually matters. 7 items. I am counting down from 7. Scrambling the order, so the one with the biggest practical value lands at the climax. Let us start with the claim you probably just watched. Number 7, what the lucky national insurance digits claim gets right, and what it gets wrong. Here is what is accurate. The last 2 digits of your national insurance number do determine the day of the week the Department for Work and Pensions pays your state pension. National insurance digits 0 to 0 through 1 to 9. Monday, 20 through 39. Tuesday, 40 through 59. Wednesday, 60 through 79. Thursday, 80 through 99. Friday. That mapping is a long-standing DWP administrative arrangement, and it is genuine. Here is what is not accurate. Those digits do not determine whether you receive a 13th payment somewhere in the year. They determine the day. The reason a 13th payment exists at all is plain arithmetic. 52 weeks in a year, divided by 4 weeks per payment cycle, gives you 13, not 12, 13. Every single person on the 4-weekly state pension cycle receives 13 payments per 52-week year. There is no lucky group. There is no unlucky group. There is no arrangement that favors one set of NI digits over another on this point. What varies from person to person is which calendar month that 13th payment falls into. And that depends entirely on the date your individual 4-weekly cycle started, not on the last 2 digits of your number. June this year contains 5 Mondays. So, Monday paid pensioners whose cycle aligns with the 1st and the 29th of June receive 2 payments inside the same calendar month. This June, that is their 13th for the year. Pensioners in other day-of-week groups had theirs fall in a different month, or will have it later in 2026. Same total, different calendar position. If someone in the comments section under that other video told you this already, they were right. Number 5, the £22.40 problem. According to the House of Commons Library Benefits Briefing, covering the 2026 to 2027 uprating, the full new state pension is now £241.30 a week, which works out to £12,547.60 a year. That figure is the result of the triple lock uprating that came into effect in April 2026. HMRC's personal allowance, the amount of annual income you can receive before paying any income tax, is frozen at £12,570 and will stay there until at least April 2028. Subtract one from the other and you have £22.40 of headroom between the full new state pension and the point at which income tax begins. If the state pension is your only income, you still pay no tax. But if you have a small private pension, any part-time earnings, or savings interest above your personal savings allowance, you are very likely already paying basic rate tax on every pound above that frozen threshold. Most pensioners never see a separate bill for it. HMRC collects what it is owed by quietly adjusting the tax code on your other income, which brings us directly to number 2. Number 2. The letters BR on your private pension payslip. If you receive any private pension income on top of your state pension, even a small occupational one, find your most recent payslip from that pension and look at the tax code. If it starts with the letters BR, it means basic rate tax is being deducted from every pound of that pension with no personal allowance applied against it. In some circumstances, that is correct, typically where your state pension has already absorbed your full personal allowance. But BR is also one of the codes most commonly applied in error by HMRC, particularly for pensioners whose state pension is below the threshold and who still have unused personal allowance available. A wrongly applied BR code can mean overpaying tax by hundreds of pounds a year with no automatic notification and no refund unless you chase it. The check takes 30 seconds. Ring HMRC. Explain that you believe your tax code may be incorrectly set, and ask for a review. The call is free. A corrected code can put money back into your account from this tax year onwards. Number 6, mandatory reconsideration, and why understanding it matters before you apply for anything. If you apply for any Department for Work and Pensions benefit and receive a refusal, you have 1 calendar month from the date of that letter to request that the decision be looked at again. This is called mandatory reconsideration. There is no charge. It requires no tribunal or legal challenge. You put your case in writing or over the phone, and the DWP conducts a fresh assessment. A meaningful share of initial refusals are overturned at this stage, often because the original decision missed an income detail or misapplied the savings rules. The reason this matters here is that the single biggest obstacle stopping eligible pensioners from claiming pension credit, which is the climax of this countdown, is the fear of being refused, knowing that a refusal is not the end of the process, that there is a free, built-in second look with no downside to requesting it. Changes the decision to apply in the first place from a risk into a straightforward step. Before the last 2 items, a picture. This is an illustrative composite, not one real individual, but the kind of case that Age UK advisors encounter week after week. Margaret is 68, widowed, and lives in a terraced house in Liverpool. She owns outright, she has the full new state pension and around £12,000 in savings left after a boiler replacement last winter. She watches the Lucky National Insurance digits video, checks her last 2 digits, finds herself in the Thursday payment group, and assumes she has missed out on something. She rings Age UK inside 20 minutes. The advisor explains 2 things. First, the Thursday payment cycle simply means her 13th annual payment falls at a different point in 2026. Nothing is missing. Nothing has gone wrong. Second, given her income and her savings, she is likely eligible for pension credit. She applies. 6 weeks later, a top-up notification arrives. Council tax reduction follows after that. The Thursday pensioner who believed she was unlucky ends up measurably better off than the headline about lucky digits ever suggested, not because the calendar was kind to her, but because she asked the question and followed one step through. Number 1, the state pension underpayment correction. Still open until March 2027. If you reached state pension age before April 2016, meaning you received the old basic state pension rather than the new one, and you are a married woman, a widow, or a divorcee, this is for you. For years, DWP computer systems failed to apply pension uplifts that groups of women were legally entitled to receive. Public DWP figures show average correction payments of around £5,900 for affected married women and over £11,000 for widows. The exercise runs until March 2027, after which these payments are gone. The group most at risk of missing out are women whose husbands reach state pension age before the 17th of March, 2008. If that applies to you, the uplift was never automatic. You had to claim it, and many never did. The Pension Service Helpline, listed on the official government guidance pages, takes the call free of charge. Ask specifically for a state pension underpayment review. Number 4. The 3 eligibility myths that stop people applying for pension credit. Myth 1. Owning your home disqualifies you. It does not. Home ownership has no bearing whatsoever on pension credit eligibility. Myth 2. Having savings disqualifies you. It does not. The first £10,000 of savings is ignored entirely in the calculation. Savings above £10,000 are treated as generating a small notional weekly income, roughly £1 per week for every £500. Above that level, which in most cases reduces the top-up slightly rather than removing. Entitlement. Myth 3. Your income is too high. The standard minimum guarantee for pension credit in 2026 to 2027, confirmed in the Department for Work and Pensions annual statutory review, is £238 a week for a single pensioner and £363.25 a week for a couple. If your weekly income falls below those figures, you are very likely entitled to a top-up. And now number 3, the climax. According to the DWP's own income-related benefits take-up figures for the financial year ending 2024, around 910,000 pensioner households across the United Kingdom are eligible for pension credit and not claiming it. The total going unclaimed each year sits at approximately £2.5 billion. The average annual loss for a household that qualifies but has not yet applied is around £2,600, and that is before counting the gateway benefits that a pension credit award unlocks. Those gateway benefits include council tax reduction, which can take hundreds of pounds off your annual bill and in some cases eliminates it entirely for pensioners on the lowest incomes. Free NHS dental treatment. Help with the cost of glasses through NHS optical vouchers. The warm home discount during qualifying winter periods. A free television license for the over 75s. And under the current means-tested rules. Pension credit is now the gateway to the winter fuel payment, the benefit removed from most pensioners and linked directly to pension credit status. For anyone who lost that payment, restoring it means having pension credit on record before the qualifying date. Add the gateway benefits to the weekly cash top-up and the real household value of pension credit. For someone who qualifies and claims is considerably higher than £2,600 a year. Set that against the 13th annual 4-weekly payment that everyone on the cycle receives. Pension credit is the larger number. It is recurring. And it carries a backdating window that closes a little more each week you wait. Applications are backdated up to 3 months from the date of claim. Every week of delay is a week of backdating that cannot be recovered. 2 ways in. The pension credit calculator on the official government guidance pages takes about 5 minutes, is anonymous and free, and gives you a clear indication of whether it is worth going further before you commit to anything. The pension credit application line, also listed on those same pages, is free to call. And the advisor walks you through every question in around 20 to 30 minutes. If the process feels daunting, Age UK and Citizens Advice both run free helplines where a trained advisor will sit with you through the application. Neither charges for it. Both exist specifically for this. 3 checks this week. 3 run the pension credit calculator on the official government guidance pages. 5 minutes. Anonymous. Free. 2. If you have a private pension, find the tax code on your last payslip. If you see the letters BR, ring HMRC and ask for a review. 1. If you are a widow or a married woman who reached state pension age under the old system, ring the pension service and ask by name for a state pension underpayment review before March 2027. If you know someone over 65 on the state pension, a parent, a neighbor, a friend, share this with them. Not for the whole video, just for those 3 checks. One of them could be worth more to that person than anything else they have read about pensions this week. One question came up repeatedly in the comments under the video you may have just watched. What about those of us on the old basic state pension? Does any of this apply? That is the next video on this channel. I will see you there.